They can't get their stock over $1 because they don't have good business operations. They're a failing company. So what do? They're going to reverse split. And that's going to take their stock. If you're a 10-cent stock and you do a 1 for 10, you're going to be a $1 stock. What will the majority not touch? That's where I want my risk to go, because I don't know which one's capable of spiking really big and which one's not. But if I look at a sample size of 1,000.
Hey guys, what's going on? Kunal here. I'm with my good friend Mike, who has been trading professionally for 10 years and is one of the best traders I've ever met with a really unique strategy. And today he's going to break down step by step how he would get started if he was starting from zero. Mike, I'm gonna hand over the mic to you, literally.
Mike. Hey, thanks for that intro. Yeah, like Kunal said, I've been trading for 10 years. And if I had to like kind of rewind the clocks and go back to the beginning, what would I teach myself day one? For me, it all comes down to the daily chart. We have to understand daily chart context before we can really get into the intraday, the entries, the exits, and the stops. So I'm going to draw a couple charts on this whiteboard here. We're going to see how it looks, and I'm going to talk about probably the best patterns that I see in the market. Now, every chart, every scenario is going to be different. It's not an exact science, it's more of a moving target, but generally, stock trading is an IQ test. If I show you a picture of a whale, can you call it a whale? We're going to do that same type of exercise, but with charts. This is the ideal version of a first red day. This is the ideal version of a multi-day breakout. And this is the ideal version of a gap and crap. I'm going to try to draw them out for you guys right now, because I think most times traders are willing to trade anything and everything that is moving. And that's not necessarily what we're trying to capture here. We're trying to capture a very specific picture that we can identify time and time again as a pattern. Pattern recognition. Simple IQ test. So let's get into a first red day, often called FRD, first red day. In my opinion, this is a stock that is going on a multi-day run. Ideally, 3 days a run, can be 2, can be 4, can be 7. But you want this very specific look on a chart where a stock starts on a run, starts to increase in volume, and starts to speed up in its price action. I'm going to attempt to draw it. So that's day one of a stock's move. Ideally, it gaps up into day 2. We get another day. Day 2. Day 3 coming at you. What we have here is a stock that's gapped up. Day 1, went on a run. Day 2, went on a run. Day 3, gapped up again, went on a run. Ideally, this is volume. It's increasing each day to the point of capitulation. There's so much demand, there's so much buying frenzy that it's going to exhaust itself, and it's going to be very hard to sustain this last day's price action. Ideally, again, not an exact science moving target, but in the most ideal world, this 4th day, we have some type of trend reversal. It no longer is doing this gap up, gap up, gap up type price action. Maybe we have a gap down, or it goes red on the day. And we have a candle that retraces a portion of the move. I don't necessarily know how much it's going to retrace when I'm getting involved, but I do know that a pullback is probable because you have a situation where longs are being patient. They buy day 1, they buy day 2, they buy day 3. Every day they see the stock going up. And you have to think about it from a retail standpoint. If they see green, they like green. But when they start to see red, that starts to make them want to sell. And if you have a situation where a stock is up from 1 to 5, it's a dynamic where there's very few buyers at 5 because the stock is arguably extended. You're buying the highs. So there's few buyers, people who have been long, maybe becoming sellers. So now there's more sellers. And then you have the whole world of short selling. And what it creates is this supply and demand imbalance, where at the top of this chart, you have a ton of supply, very little demand, and you get something that is a very predictable pullback in price action. And that is a situation that I'm trying to capitalize on every single time. I want to be short on this candle, capturing a portion of the move, a portion of the pullback.
Mike, now do you short it the first day, or do you let that first candle, that first day red candle close, and then the next day you're coming in?
I'm coming in the first time it's going red.
Okay.
The first time that it's red on the day. The first time it's below the previous day's closing price.
So it fails its gap and it's rolling over, and
relatively, it's weak compared to the other few days.
Sure.
Now, just because it's red doesn't mean it's dead. Some of these are going to kind of pull back and come back and make new highs.
Sure.
That's an automatic stop out. And I move on to the next setup.
Interesting.
That's my bread and butter. That's what I've been trading for at least 8 years, and it goes back as far as time. I've seen this work time and time and again, and for me, it makes a lot of sense in terms of the supply and demand and the psychology of the buyer and seller at this moment.
There's nobody left to buy.
And there's a lot of people left to sell. So the next step I'll talk about is the gap and crap. This is one that took me about 8 years to finally start trading. For the first 8 years of me trading, I never traded a gap and crap. I didn't know how.
Particular reason?
I didn't know how. Everyone always taught me that a gap and crop is a situation where stock previous day is here, and the next day in the pre-market, it's opening up, let's call it 100% higher. And I was always taught that stock spikes, cracks hard, we're going to short the lower high, risk high a day, and hopefully be there for a fade.
Sure.
But what I found out happened was a lot of times the stocks would kind of start to pull back, rip to new highs, I would take a loss, and then it would pull back and make a fade. I believe that the price action was weak and showing me lower highs, but there were still fake outs that happened. I mean, we're dealing with small caps, so manipulation is rampant.
Sure.
And if they want to stop us out and create like a little liquidity pocket of all the short sellers getting in, and then they can play the opposite side, they will. That's probably advanced information, but my goal for gap and craps now is to avoid the noise. So the way that I personally found edge doing it and backtested it to some degree is we have the same situation. Stock starts here and gaps up 100%, opens here. What I found is instead of playing the price action where it's going to be doing something of this sort, I like to get short when we start to make a lower low, and I don't risk high a day. I risk something really wide. Sometimes it's 20%, sometimes it's 30%, sometimes it's 40%. Now that sounds wild. And it's not 40% of my account, it's 40% of the stock price.
Sure.
So my risk is still 1R. And I understand that this is maybe a higher win rate, and for a higher win rate, I'm going to sacrifice risk reward.
Sure.
If I'm going to be right more often, I don't necessarily need to make 2 to 1, 3 to 1, 4 to 1. I can make 1 to 1 if the win rate's 70, 80, 90%. I'm going to end up on top at the end of the day.
I'm like that too. It's like 1.5. I'm still doing it.
Yeah, I mean, they can pay the bills.
Yeah.
But even under 1 can still pay if the win rate is extremely high. So my whole goal here now is to avoid the noise. I call this all noise. I don't have a good understanding of price action. I don't have a good understanding of level 2 or times in sales.
Sure. It's not 1972. You're not sitting there with a ticker box.
No, and I don't think it's some people have that trait. I don't think it's necessary. I think what's more important is understanding daily charts and understanding context of where we are and what is going on. So with the gap and crap, the reason I think that you have potential for profit is because I deal with small cap. So when I'm talking about gap and craps, I'm talking about stocks under 300 mil market cap.
Sure.
And I think majority of the reason that these stocks are gapping up is because they are new age pump and ducks. These stocks are coming out and saying, hey, we're going to cure COVID. We have earnings. We have this, we have that. And some of that stuff will be real, arguably. But most of that stuff is not going to be real because there's an agenda behind this small cap company. They need to get money. They need to finance their operations. And their operations are probably not that great. So what are they going to do? They're going to go to lenders and say, hey, we're going to give you stock at a much cheaper price. And you're going to be able to sell that stock into the open market. And what these companies do is they release a press release to get the stock up, to bring liquidity into the stock. And once mom and pop, Joe Schmo, start buying the stock because they read the press release and they believe in it, the company themselves or the lenders are going to start dumping into that buying volume. It's not guaranteed every time, and not every stock is dilutive, but the nature of small cap is most of these companies don't have revenues.
And what is I don't trade many small caps anymore, but I noticed that now when these PRs come out and these things rocket, there's always like a reverse split like 5 days before, 10 days before. But is this like a new thing or has this been going on forever? So it seems like they just reverse split and then that PR is coming out.
Yeah, and it does kind of happen in that cadence because the reason they reverse split is because they got to hold their stock over $1. There's certain compliance rules to staying listed on the NASDAQ or the New York Stock Exchange. And one of them is you have to kind of be a stock that's over $1. Sure. And at some point, they're going to come in and say, hey, if you don't get your stock over $1, you're going to get delisted. So what do? They can't get their stock over $1 because they don't have good business operations. They're a failing company. So organically, it's hard to find appreciation. So what do? They're going to reverse split. And that's going to take their stock. If you're a 10-cent stock and you do a 1 for 10, you're going to be a $1 stock. Now, your market cap hasn't changed. Fundamentally, you haven't changed, but the price has changed.
Yeah.
And that's all that the NASDAQ really cares about for you to stay listed. You have to stay above a certain price threshold.
Okay.
So what we're seeing more and more lately is not just 1 for 10, but like 1 for 50, 1 for 100, 1 for 200 reverse splits. So stocks can get their price up to $5, $6, $7. They'll decrease for a couple of days. And once they get closer to that buck range, the more probable you're going to see a press release. So they can jack it above that dollar range and then it can just trade sideways or slowly downtrend on no volume. And they can satisfy that condition again. So that's why these companies are reverse splitting. And then once they get their share count readjusted, then the whole dilution process, the the machine just starts to run again. And it's rinse, wash, repeat. I've been trading the same tickers for 10 years.
Yeah, and you'll see, I noticed like some of these companies just reverse split like every 6 months.
So my whole goal with the gapping crap is to get an entry on some type of lower low. Chart starts to break down. Chart starts to show signs of weakness. I don't know if it's for sure dead yet, but it's my best guess as to when it's dead. And I'm not risking a level that the 90% are risking. I want to risk something different. I want to risk something that I backtested that's kind of stood the test of time and is situated in kind of like objective fact.
Sure.
Meaning, what is the average spike on these things? How far do they generally go? What will the majority not touch?
Mm-hmm.
And that's where I want my risk to go, because I don't know which one's capable of spiking really big and which one's not. But if I look at a sample size of 1,000, how many of them are going to spike 50% from the open? How many of them are going to spike 100% from the open? And where is the optimal place to place your risk so that no matter what they do, up or down, I can stay short, I won't get stopped out majority of the time, and I can be in a winning position. So the two things I tracked was how much does the stock spike, and on average, how many of these close below the opening price.
Do you use any tools for this, or is this manual?
This is, I've used a tool called SpikeEat. Okay. SpikeEat.com is a great way to backtest. You can do a manual through Excel and watch every single one, but the issue with doing it manual, and I think there's been so much great technological advancements in the past 5 years that allow, when I first started, it was very hard to backtest. You had to be like some science whiz.
Yeah, you're sitting there with the codes.
With the codes. Now you don't really need codes. There's Flash Research, there's SpikeEat, there's Edgeful, there's so many, Quanted, there's so many that I see on Twitter that allow you to backtest by just entering parameters. So the main things that I backtested was how much do these on average spike, and on average, how many will close below the opening price.
Nice.
And that gave me some type of understanding that, hey, most of them will fade to some degree. The number I saw was 67% for what I was tracking.
Sure.
So more than half of them will fade, and most of them will not touch 40%.
That's the way it goes. Guys, if you notice, like he's doing something that it seems so simple, but nobody will do it, right? Which is like the nitty gritty work of actually getting your hands a little, right? Getting them on the keyboard and actually doing real legwork. Like we all talk about it. The great traders do it. But when it comes down to you have a bad day, or you had a hard day at work, or your girlfriend calls you a loser, people don't do the work.
Yeah.
And that type of work there, like backtesting, frankly, it's not that fun. But you have to do it. And the people that are doing it, and they do it right, they're always the ones that you see making money. Like it's just, the work is the work.
Yeah. And I think one of the more important things here is also like understanding the framework, right? Like we're talking about first red days, we're talking about supply and demand imbalances, and we're talking about gap and craps. And I'm talking about like the reason why do gap and craps, why do 67% of them end up fading? And the reason is because of how small cap runs. It shows this dilution machine. They need to get their money somehow, and there's no other way for them to get money because they are failing businesses. So they dilute onto retail. They create these press releases to entice people to buy, and then they sell their paper onto the people buying. And so my job is to find a strategy that allows me to capture some of that edge, to capture this nuance that exists in small cap. Those are the two main things, right? Like as far as short selling goes in small cap, that's what I focus on. Those are majority all of my trades.
So you primarily short, or do you still take on these pump and dumps? Do you like to get in on some of the pumps?
Every now and again, I will get involved, but it's so much less structured that I think it invites disaster.
Okay.
And as a trader, I'm trying to avoid disaster at all costs. I don't want to put myself in uncomfortable situations where I don't really have a plan, situations where it can get away from me.
You have to do what you're good at.
Yes. And I think that the edge, given the nuances that we're seeing here, is towards the short side majority because these companies are horrible.
Sure.
But some of these will squeeze the living crap out of the short sellers. So it's always important to have a stop loss before I make any trade, before I ever execute a trade. In my trade plan is, what's my stop?
Okay.
I don't create that as I go in, and I'm not involved and then changing it around.
Okay.
For the most part, it's been decided, and that's a really important aspect that I wish I knew in the beginning, because too often I see traders getting in short, and then, you're 2 hours into the day and you've made a lot of decisions, and now things are happening, you're making new plans on the cusp. And that can be a very dangerous situation for newer traders. People ask me, people know me, Mike Huddy, as a short seller.
Yeah.
And it's not that I want to be a short seller. It's that the edge is in short selling in small cap, right? In this dynamic where these companies are horrible that have zero revenues, that are diluting onto people who are buying their stock.
Sure.
It makes sense to be a short seller. You're going to have more opportunity as a short seller. There's more frequency.
And in this type of market, there's more opportunity than ever because there's a 200% gainer every day.
Right. And it's usually BS. Not always, but generally speaking. I love people coming to the market. I love players. I love volume. you know?
You need the action.
I need the action. For every seller, there's a buyer, right? But the main point is for people to kind of understand what we're doing here. Yeah, and how we approach the market is more important fundamentally than, because so often I see people just like, they come to the market and they want to learn how to trade what they want to trade. And that's not necessarily it. You gotta like come into the market like you don't know anything. Like stop thinking and learn what the market is.
Sure.
Because most people will come in long biased. Most people will come in, they want to buy stocks. And that's what I did when I came in. I wanted to buy stocks, but I found throughout 2.5 years of trying to buy stocks that most of them didn't work out. And if I wasn't buying them and if I was shorting them, maybe I'd be profitable. But you can't just short every single stock.
No.
That wouldn't make sense. You need specific situations. You need specific patterns. And the issue with short selling is I've seen it related to it seems really like a heroin, right?
Sure.
Where it's like, you have a stock that's extended, it has a first red day, you lose, it gathers and it goes higher. So it's the next day of first red day, you lose, it gathers, it goes higher. And so every day it becomes a better and better opportunity.
Yeah.
And every day you have to risk more and more money. And so that can be a very dangerous wheel to get caught into. And it can be very hard to give up on the stock. So I kind of like, if a stock has already proven to be kind of a headache, I want to ignore it.
Do you have like any parameters, like if the float is too low or if the range is too big, like you're just like, this looks like a stressy McGee. This is the hot redhead that you meet in Scotland.
This exists.
They do exist. I'm a married man now, but boy.
I like to avoid floats under 1 mil, especially for the gapping crap. You're just going to get situations where it's whipsawy. They can have halts. They can move the price action a lot easier because there's a thinner supply. And so under 1 mil floats, I'll tend to avoid.
Sure.
And I think it's a great rule for most newer traders because they're harder to manage. The thicker the float, the more thick the stock should trade, although it's not an absolute rule and anything can really happen in the markets and you should be aware of that. But when you're under 1 mil float, it can be wild.
Okay.
So I like to avoid those. And for me, as like a trader, like if I'm trying to short a gapping crap, I don't want to short a $1 billion company because it might not be horrible. It's a $1 billion company. They might have revenues.
They might even have some people working for them.
They might have
smart.
People. They might have an address, right? They got completely different.
They might have an office.
I'm telling you guys general assumptions, but of course, case by case, it can be a different scenario. So I'm trying to put myself in the bucket of stocks that are likely to be what I'm trying to describe.
Now, do you need like specialty brokers for this, or you rolling with Robinhood?
No, I use Cobra, Centerpoint, Sage Trader,
Wherever you can get it.
wherever I can get the locates. Like I don't want to miss the opportunity.
Sure.
And I also have an E-Trade account.
Me too. I love E-Trade Pro so much.
It works, and sometimes they have the shares to short.
So I love E-Trade Pro so much.
So sometimes I'm locked out of my brokers because of like a buying problem.
Sure.
Buying power problem where it's like I shorted a stock and I don't have any buying power that next day. Sometimes E-Trade comes in clutch and I can short with them. So
Yeah.
I used to say that you have to play the broker game. You probably need 1, 2, or 3 brokers in order to be able to make sure you get the shares to locate, make sure you're able to ask that opportunity, make sure you watch that opportunity.
Thanks, Mike, man. That was amazing. Dropping knowledge like that. Where can everybody find you?
You can find me at Mike Huddy on Twitter, at Mike Huddy on Instagram, and we also have a community of traders at clovertrading.io.
Guys, you'll find him everywhere. He's crushing it. Him and his crew are really sharp guys. We've chatted about a lot. He's referencing something on these daily time frames that's really, really important. The big ideas come from the big ideas, from having structure and framework. And Mike really went over that in such good detail. I think this is going to be great knowledge for you guys. You know where to find me. I love you guys. Peace in the Middle East.